Leveraging the potential of stock investing is the best way to guarantee your financial success for the rest of your life. Many people have become wealthy through the stock market, but regrettably, most people are reluctant to use the most effective method of earning money on earth. How come? Simply put, they have no idea where to start when it comes to investing, and because of this, they are unable to reach their full financial potential. Fortunately, I'll show you how to value a stock and invest money wisely in this video. But before we get deeper, if you are new to this channel, hit the subscribe button and the notification bell so you don't miss any of our videos. So, without further ado, let's get started. To choose and invest in stocks that will not only yield you a handsome profit but also help you increase your wealth over time, you must first understand the characteristics of a company and the stock that represents it on the market. Only then can we discuss how to value a stock. The first characteristic is the cost. When evaluating a company's stock, knowing the share price history will help you determine whether or not you might be able to buy a profitable stock. Second, there is revenue growth, which usually occurs at a higher share price when a company's revenues rise. Generally speaking, it is safe to invest in company stocks if revenue growth is consistent with them. The third is dividends. Only invest in thriving businesses that can afford to pay high dividends to their shareholders. Look for companies that do this. Not to mention, even if the value of the stock you own doesn't rise as quickly as you would have liked, you will still benefit from the cash or stock dividends it pays out, ensuring that you advance in your quest to accumulate wealth. Market capitalization comes next. Extensive and diversified companies can typically withstand a negative impact from even a slight change in market conditions. Consider businesses like Coca-Cola or ExxonMobil. They are substantial, diversified businesses that have provided long-term profitable returns to their investors. Following that are historical prices. When searching for stocks, it's important to look beyond just the share price right now and consider the company's share history. You can go back 5, 10, or 15 years to see how the business has performed over a significant amount of time. Your best bet is to invest in companies with solid historical share prices. However, remember that past events don't necessarily predict what will occur in the future, even though they are still excellent predictors. The industry is the last characteristic. Examine the sector in which the company operates before you buy any stocks. You would be advised to back off if the industry is in decline or is becoming less relevant. On the other hand, you can feel secure investing in an industry's stocks if it is growing. After learning the fundamentals of a company and its stock, it is crucial to comprehend the financial indicators you should use to determine whether the stock is set up so that you can profit from it. A stock's value is typically determined by 4 indicators, and using these indicators in tandem will give you the information you need to choose investments more wisely. Indicator number 1. The price-to-book ratio. If a company were torn apart and sold today, its value would be determined by its price-to-book ratio. This is important to know because many businesses in established sectors struggle with growth, even though their assets may still be valuable. Equipment, structures, real estate, and anything else that could be sold, such as stock and bonds, are typically included in the book value. The book value can be defined as the difference between an organization's assets and liabilities. Understanding this is crucial because certain businesses with weak book value positions can be risky investments. Consider the case of Enron. The company's stock price was solely based on speculative activity, and the assets it owned were of little value. The book values of some companies will fluctuate more than others. Because these stocks frequently have a portfolio of assets that fluctuate in value, the book value of purely financial companies may change along with the market. A low price-to-book ratio can safeguard you in either scenario, but only if it is accurate. When the price is less than the book value, it indicates that market speculation has less of an impact and that the price more accurately reflects the true value of the company. The assets that make up the price-to-book ratio must be examined in greater detail by an investor who uses it to value stocks. Indicator number 2. The price-to-earnings ratio. Perhaps the most closely watched ratio is the price-to-earnings ratio. A stock's price can rise without material earnings growth, but the P/E ratio determines whether it can continue to rise without earnings to support it. A stock will eventually regress. It's crucial to remember that companies in comparable markets and industries should only have their PE ratios compared. This is due to the more speculative nature of some industries than others. For instance, the possibility of discovering new oil drives the operation of an oil refinery. Even if there haven't yet been any profits from this oil realized, a discovery can increase stock prices. The value of a household goods company, on the other hand, is entirely based on the revenues it generates, so its price-to-earnings ratio will be a better indicator of how much money the company is generating effectively. If there is no change in the company's operations, the price-to-earnings ratio can be thought of as the time it will take for a stock to return on its investment. If a stock has a PE ratio of 30, an investor might purchase it if they believe its earnings will double annually. The stock will return to a more reasonable price-earnings ratio if this doesn't happen. Indicator number 3. The price-to-earnings growth ratio. Many investors use the price-to-earnings growth ratio rather than just examining the price and earnings because the price-to-earnings ratio is insufficient on its own. The historical growth rate of the company's earnings is taken into account by the price-to-earnings growth ratio. This ratio reveals how the stock of one company compares to the stock of another. The price-to-earnings ratio of a company is multiplied by the earnings growth rate over the previous year to arrive at the price-earnings growth ratio. The lower your price-to-earnings growth value. When using the price-to-earnings growth ratio to compare two stocks, a peg of 1 indicates that you will break even if growth continues as it has in the past. When compared to a stock, a peg of 2 indicates that you are paying twice as much for anticipated growth. Since there is no assurance that growth will continue as it has in the past, this is speculative. With the price-to-earnings ratio serving as a snapshot of a company's current situation and the price-to-earnings growth ratio serving as a graph showing where it has been, an investor must determine whether it is likely to continue in that direction. Indicator number 4. Dividend yield. When a stock's growth slows, having backup is always a plus. Due to this, many investors find dividend-paying stocks to be appealing. You continue to receive a paycheck even when prices fall. The dividend yield demonstrates how much of a return on investment you are receiving. That percentage can be compared to the interest on your savings, with the added potential for growth due to stock appreciation. Although the dividend yield appears straightforward on paper, there are a few things to be aware of. For example, if you have $2 million invested in dividend-paying stocks that yield a 3% annual dividend, you've achieved financial independence and can quit your job. By now, you ought to be aware of the important indicators to consider when evaluating and subsequently buying stocks that will increase your wealth. There is a less complicated option, index investing, for investors who want to use the stock market's power to increase their wealth without studying all the financial data I just mentioned. This is where you invest in funds that closely resemble the market, and over time, this strategy can help you generate reliable returns. Fortunately, you can increase your wealth over time by investing in undervalued stocks or making small contributions to index funds. But the only variable that will affect your income is time. Compound interest takes time to work, so the earlier you start investing, the better. Let's look at an example to show how advantageous it can be to begin investing at a young age. As you can see, oftentimes not even increasing your investment amount will be able to offset the benefits that time will bring. Therefore, The key is to start as soon as you can, whether you invest in individual stocks, mutual funds, or index funds. Well, there you have it, guys. Thanks for watching. If you're new to this channel, make sure to subscribe and hit the notification bell button to get updated on our latest videos. Don't forget to like this video and drop a comment. See you next time!